My name is Dean Wilson, and this is our REIT project presentation. I'll be going over our REIT's description, investment strategy, and property portfolio. So our real estate investment trust is Equinix, which focuses on data centers. It was founded in 1998 by Jay Allison and Al Avery, and it focused on building multi-tenant data centers where competing firms could connect and exchange data. And to better reflect this mission, it was named Equinox, which stands for Equality, Neutrality, and Internet Exchange. They had their IPO in 2000, where they were listed on the NASDAQ. And since that IPO, they have rapidly expanded their global presence, penetrating European, Latin American, African, and Middle Eastern markets. And in 2015, they converted to a REIT for tax purposes and to distribute dividends to their shareholders every 4 years. Oh, and today they have a network of over 260 data centers in 33 different countries. So Equinix's mission is to be the trusted platform for digital leaders and innovators to come together, exchange ideas, and build the infrastructure for a more connected world. To build this trust, they have many security measures in place at their data centers, including biometric cabinets or biometric scanners, secure cabinets, and cameras. They also have proven themselves to have reliable platforms. In 2023, they reported over 99.999% operational uptime. And for digital leadership and innovation, they have partnerships with over 10,000 companies that all share their data with each other in the Equinix data centers. They also innovate as they led the shift from single tenant data centers, where it's just one company and their information, to multi-tenant multi-tenant data centers where everyone shares their information with each other. This goes along with their goal of interconnectivity, their network of 260 data centers representing the data industry's largest global ecosystem. And to accomplish this mission, they also leverage environmental social governance. Environmentally, they are leading the charge to reach 100% renewable energy coverage by 2030. They're already at 96%. Socially, they recognize the benefits of a diverse work culture. And for their governance, they are promoting ethical practices and unwavering values. As for their investment strategy, they rely on the network effect, which basically means the more people that use their data centers, the more information there is, and the more attractive that is to other partners. They also rely on using the partners of their current partners to further expand the network. They also rely on a mix of recurring and non-recurring revenues. Their recurring revenues coming from their contracts that typically last 1 to 3 years and are billed on a monthly basis. They also have some non-recurring revenues, about 10%, which mainly come from installment fees and revenue from canceling a contract early. And for expansion and acquisition, they're looking to build more data centers and increase their global footprint. They mainly decide this on a number of criteria, including the data center's capability and the country's capability to provide for them. And this is their property portfolio representing 6 different countries and 33 different countries and 6 different continents and 260 data centers. And their customer base is a mix of 5,000 enterprises, 3,000 cloud and IT services, and 2,000 network services. And this also a mix of private and public clients. And this is their cabinet utilization, which is basically how their data centers are being used. And right now they're at 80% capacity, which is a good standard. Oh, and as far as diversification is concerned, they're doing well as far as, they represent the largest network, but somewhere a place where they might run into problems is with their government contracts, because governments are under pressure to reduce their spending, and they can also cancel their contracts for any time. So overall, they are heavily diversified, but there is always that risk with government clients.
We will now move into the management structure of Equinix. Its management structure mirrors that of corporate management. It is publicly owned and shares are traded on the NASDAQ. It has an executive board made up of 13 members. A few of these members are Charles J. Myers, the executive chairman and former CEO and president, Adair Fox Martin, the current CEO and president, and Josh Lynn, an external vice president and general manager of data center services. Each of these members, as well as the rest, have prior experience in the technology industry and have seen great success in their careers. There's also diversity among the members in gender, race, and nationality. Their differing backgrounds and experience can be applied to management strategies worldwide. Josh Lynn is also the executive sponsor for the Asian and Veterans Employee Connection Network, and also works externally with the Asian American Foundation, working to facilitate diversity in the workplace. The ownership structure of Equinix is made up of about 14% insider ownership, around 29% mutual funds, around 50% institutional investors, and around 7% public companies and individuals. This insider ownership can signal confidence in the REIT and also is an incentive for the executives that own shares to continue profitability of Equinix. Equinix essentially functions as a digital infrastructure company, having physical properties, which are data centers. These data centers house large amounts of servers and other computing technology, which they lease to companies across the world. These companies lease physical space and also digital space within these data centers. An example of one location is their Dallas campus, which is made up of 8 data centers that Equinix manages. Equinix also recently acquired the Dallas Infomart building, which is a large data center located downtown in the central business hub near many of their clients. Overall, their properties have performed well. In 2023, operating income increased by 20% over the previous year, and net income increased by 38% over the previous year. In the first quarter of 2024, operating income increased by 20% over the previous quarter, and net income increased by 2% over the previous quarter. This shows a continuing increase in profitability of Equinix. There have also been some recent developments. Equinix manages 260 data centers, with 14 being opened in the past year. They are also continuously updating the hardware of these data centers, recently focusing on cooling hardware to support the recent spike in AI development. They also recently launched the Equinix Fabric Cloud Router, which is a virtual routing service that minimizes networking challenges for companies. It's easy to use and adaptable to the specific needs of each company. They are also dedicated to their future first sustainability strategy. They are utilizing investment-grade green bonds to help fund their goal of becoming climate neutral by 2030. One project that goes hand in hand with this goal is their Equinix Heat Export Program. The data centers and the servers and technology housed within them produce enormous amounts of heat, which is wasted by being dispersed into the air and not capitalized upon. So Equinix is partnering with utility service providers and municipalities to transport this heat into usable heat for nearby developments in residences and businesses alike. They also offer third-party services along with their primary services. These services come from outside providers and are optional for each individual client. They have separate usage term and no revenue goes to Equinix, but they can enhance the functionality of Equinix's services to be tailored to each individual client.
Howdy, I'm Trey Zune, and I will be going over the net asset value and balance sheet analysis for Equinix. To find the current value of the assets, we took the company's reported NOI for 2024 of $1,466 million and divided that by the cap rate of 2.1%. We then subtracted out the liabilities of $19,613 million before dividing that by the total number of shares outstanding, which was 94,665,000. This got us to the NAV per share of $545.47. The current stock price, however, is $756.60 per share, which is 38.7% premium compared to the median premium of 15.2% according to Statista. Being 13.5% away from the mean shows that the NAV may not be the best metric for measuring Equinix strength as a company. For the leverage of Equinix, we found that their leverage ratio is 61.4%. According to REIT Institute, the ideal leverage ratio for REITs is around 62.5%, which lines up perfectly with our calculation of Equinix leverage ratio. We also found the leverage ratio of one of Equinix's greatest competitors, NTT, which we found to have a leverage ratio of 62.2%. This goes to show that Equinix is using leverage properly and safely in order to maximize returns without taking on more risk than their competitors. We used some measures from the balance sheet to interpret the strength of the company as well. We found the percent of liabilities to total assets to be 61.4%. This is a healthy measurement because it shows that every dollar of assets the company has, 61 cents are debt, allowing higher returns without adding unnecessary risk, which follows what others in the industry are doing. We calculated the floating rate debt as percentage of liabilities to be 66.2%. However, we would not recommend using this metric because it was not specified in the notes, which of the senior notes were floating rate, so we lumped them all into the same calculation. And then for their sensitivity to a change in short-term and long-term rates, we found that Equinix uses multiple different programs and instruments for hedging against interest rate risk. With these net investment hedges and cash flow hedges, it is unlikely that they will suffer great loss in the case of unfavorable interest rate movements. Fixed charge coverage was calculated by taking their EBITDA, and dividing by their interest expense and their capitalized interest. Equinix does not have preferred dividends, so there was not a need to use them in the metric, where we found that their fixed debt coverage to be 8.78, which is a very healthy measurement, meaning they're able to pay their fixed expenses on time and with ease, up to 8 times as many times as they need to. And now their debt maturity schedule is shown here, where they do not have a single year that has too much debt coming due. They've done a great job spreading out their notes maturity dates in order to avoid any detrimental years where they have too much debt coming due at the same time. Overall, Equinix balance sheet shows strong metrics and measurables that show strength and stability for the company.
Howdy, my name is Mac Trinkle, and today I'm going to go ahead and start with the earnings outlook of Equinix. And first of all, when you look at the earnings outlook, pulling multiple analyst reports, you could tell that they have a funds from operation growth rate of about 10%. Along most of these reports, it's kind of all similar within that 10% range, a couple 9%, a couple 11, a couple of 12, but that's mostly kind of the average that I was able to pull from our reports that I was reading. And in the first quarter of 2024, when they released their reports, we noticed they had $840 million of funds from operations. And I believe that was about roughly a 9 to 12% growth with a couple of assumptions, inflation, things like that, that take into account was roughly 9 to 12% growth rate from quarter one of 2023. So when you take that into account and look at a couple other things, that to me looks very reasonable and very sustainable, right? This is one that has improved, I think, year over year from the 2024 projected funds from operations that they are anticipating getting, it stays around that 9 to 12% growth rate. So very reasonable, very sustainable. They have their pieces in a line to not only continue this growth rate but build upon it. So the industry average and things that I pulled from those analysis reports are very true, and to me, it's a fair assumption. So next, to further that step, we're going to go ahead and cover the dividend yield a little bit. So in millions, this quarter, back to that report, they paid out about $412 million of dividends. When you break it down based on their per share, which is the same amount of shares that they noted in their report themselves, that they use in their calculations for FFO per share, earnings per share. And that's the number that I went and pulled, and it comes out to $4.35 per share. Divide that out by the current stock price, which gives us a 0.58% dividend yield with a 49% payout ratio. Pretty similar long term from what we've kind of seen. They have a very steady dividend yield growth and dividend per share growth. And they typically take, as stated in class and through the notes, they typically know and they understand the fact that most people are investing in this REITs because the dividend yields and the dividends that they're going to get as that secondary income. And it's something that is common and that they're going to hold on to. So Equinix knows that from a company standpoint. So they definitely prioritize their dividends. And I think this is somewhere where we tend to shine. We earn more, we pay more, and we understand that process. So lastly, we'll go ahead and cover stock price performance. So overall, all time 82% growth is really good. And we've seen over the past 3 years decline of 8.43%, which isn't too far off from REITs as a whole and equity REITs. One thing that stands out is data centers have had positive growth, which is one thing we definitely need to look at being in that same realm. In the past 5 years, though, we do outperform not only all REITs, as well as equity REITs and data centers. So in the past 5 years, it's almost double of growth rates of stock price. So next, we're going to look at a couple graphs. So this is the stock price, just on the market trading. The past 6 years, as you can see, pretty steady growth overall, some ups and downs, but if you look at it from a whole, a lot of growth there. So and then so back to the 5 year returns. I kind of want to cover this a little more. Apologies for my stutter there. So over the past 5 years, as I said, we're relatively pretty much, if you average them out, double the growth rate of stock price, as is from all REITs, equity REITs, and data center REITs. So that to me stands out the most. If you look over that combined with an 82% overall growth rate, a lot of positivity there. And the fact that we're not only performing as well as the market and the industries are, but we're outperforming that, right? I mean, you could have a 10% growth rate, but if the rest of the market and the industry is outperforming you and outgrowing you there, then it doesn't really mean much. And this is where I think we stand out, right? We're not with the industry. While this has been a very profitable industry to invest in, we're above that, and we kind of rise above those prices of. If you look at data centers right there in the graph, it's under 20%, and we're just right at 30. So that's a 10% increase over data centers. And we start getting to large figures, you're investing $1 million, there's a $100,000 difference that you could have with Equinix. So positive stock price performance, and I think this growth rate will continue on, especially with factors like funds from operations growing steadily and consistently, as well as dividends. I think this is all fair assumption where the company's at.